Thank you so much for joining us today, and welcome to today's fourth and final Financial Foundations webinar series, Credit and Debit 101. We're so excited to get started. Today, joining us is Tierney Henderson and Melissa Restivo, walking us through the importance of building responsible credit and everything that has to do with credit and debit. So without further ado, I'll pass it over to Tierney to get us started.
Okay, great. Thanks, Barrett. Hi, everyone. I'm Tierney. I'm an advisor in our San Francisco offices.
Hi, I'm Melissa, and I'm an advisor in our Seattle office.
So, as you all know, today we're going to be talking about credit and debit, but there's really not that much to say about debit. So, we're mostly going to be talking about credit. And credit is often one of the first areas of financial planning that we're exposed to. There's so much marketing and messaging out there to convince us to sign up for credit cards and get points and get rewards. And it feels like every time I'm on an airplane or checking out at the mall, there's a new credit card offer. So, it can be very tantalizing and it can also be dangerous if we don't have a solid understanding of how credit works. So, our goal for today is to demystify credit. We're going to talk about what credit is, how credit cards work, what impacts your credit score, and how to build strong habits.
All right, before we dive into the presentation, let's take a look at a few recent headlines because they show why understanding credit matters. One report found that credit card debt in the United States has reached record highs, while another showed that people are relying on credit cards more for everyday expenses like gas and groceries. And what that tells us is that credit is becoming a bigger part of people's daily lives. And without the right habits, debt can add up quickly. We also continue to see news stories about fraud and scams and stolen credit card information, which means that managing credit isn't just about spending wisely. It's also about protecting your financial information. And then there are ads for rewards and signing up for all different types of credit cards with huge bonuses or airline miles. And while those offers can be valuable and also very tempting to sign up for, they're only beneficial if they actually fit your spending habits and your financial goals, which Tierney and I will touch on later throughout the presentation. But the key takeaway from this slide is that people are relying on credit more than ever. Debt levels are rising, and our financial choices really matter. And that's why building good credit and understanding how it works can make a big difference in your financial future. So let's talk about what credit is and why it matters. So what credit is, in simple terms, is it's the ability to borrow money and pay it back later. So anytime you use a credit card, you take out a loan, or you finance a purchase, you're borrowing money. And what you're doing is you're agreeing to pay back the lender later. So also think of credit as your financial reputation. So just like you build trust with a new friend or a family member over time, you also build trust with lenders by showing them that you could borrow money from them and then pay it back responsibly. And over time, those borrowing habits and repayment habits create what we call your credit history. And so why does any of this even matter? So when you're applying for things like credit cards, a car loan, maybe even an apartment rental, and one day a mortgage, companies will look at your credit history to help decide whether to approve you, and if they do, whether you get a decent interest rate, a high interest rate, or a good one, hopefully. But poor credit, on the other hand, can make borrowing even more expensive. So, for example, imagine two people go to a car dealership and they're looking at the same exact car. They both are going to finance it. One person has a strong credit history. They will qualify for the lower interest rate, while the other person has poor credit and they'll end up getting a higher interest rate. And what happens is over the life of the loan with the higher interest rate, that difference could cost thousands of dollars. And that's why understanding credit is so important because the habits that you're building today can help you create a strong financial foundation. And it does help open the doors to more opportunities and a huge savings and interest. And your credit history stays with you for a really long time. So just to reiterate that making smart decisions now can benefit you for years to come. All right, so now that we know what credit is and why it matters, let's talk about the difference between credit and debit cards because people tend to often think of them as the same because they are used the same. You're still tapping your card or inserting your card, but they do work very differently. So let's say you stop at Subway and you buy a sandwich for $15. If you use your debit card for that $15 sandwich, it comes directly out of your bank account. So if your checking account had $100 in it before buying the sandwich, you'd have $85 left in your bank account. So what you're doing is you're spending money that you actually have. On the other hand, when you use a credit card, the transaction looks the same. So you're still tapping your card or inserting your card, but what's happening behind the scenes is different. The credit card company is paying Subway for your sandwich, and then you're agreeing to pay the credit card company back later. So I like to think of this as a small loan. So let's say throughout the month, you're using your credit card for just your regular purchases, gas, groceries, maybe a few Subway lunches out, you might spend a few $100s before ever making a payment. Then at the end of the month, the credit card company will mail or email you your statement, and it'll show everything you charged and how much you owe, and it will also show your payment due date. So a simple way to think about the difference between debit and credit cards is that debit cards are spending your money today, while credit cards are really spending someone else's money today, and they're asking you to pay it back later. And another big difference between the two types of cards is that credit cards help you build your credit history. So every month you're showing lenders whether you can borrow money and pay it back responsibly. That's why many people start using a credit card for small everyday purchases, even if there's cash available in their checking account. And the reason that they're doing this is because, not because that they need to borrow money. They're using it because they're building a track record that can help them later when applying for things like car loans, apartment rentals, or a mortgage. So it's really helping their credit history if they're paying on time. So now that we understand the difference between debit and credit, I'd like to walk through exactly how credit cards work and what happens after you start using one. So let's say you get a credit card with $1,000 limit, and that's basically what it is. It's the maximum amount that the credit card company is willing to lend you. So imagine it's the beginning of the month. You use that credit card for gas, grab coffee with your friends, pay for your Spotify subscription, and maybe you buy a few things online. By the end of the month, you might have charged maybe let's say $300 to the card. Then after that, after your statement closes at the end of the month, the credit card company will send you that statement showing you the three things we talked about earlier. These are really three important things to look at: how much you spent, how much you owe, and when your payment is due. At that point, you have a couple choices. So the best option is to pay the full $300 statement, because if you do that, you're avoiding interest charges. And you don't have to actually pay it in full in one payment, as long as you make payments sometime during that month before the payment due date. So that'll help you pay off the principal before you start accumulating interest charges. So another option is to make only the minimum payment, which is also another good option. But let's say, for example, you get that $300 statement in the mail, and the credit card company is saying your minimum payment due this month is $25. Okay, so if you pay that $25, your account stays current, which is great. but at some point you still owe that remaining $275. So if you don't pay that, what happens is the balance carries over to the next month, and that's when interest starts adding to the amount that you still owe. So what I like, how I like to think of this is like a snowball effect. So like at first the payment seems small and the charges seem like maybe not a lot, but if you keep carrying that balance from month to month, it starts to grow fast. And I won't get too much into detail about this right now because Tierney has a really great slide that'll show you some visual examples of how quickly interest can accumulate and how much you might end up paying at the end of that loan, or maybe if you're paying off your credit card over 6 months. So, one of the best habits you can develop is to think of your credit card like your debit card. It is not, a credit card is not extra money. It's simply a tool that gives you flexibility. It helps you build your credit, and you can also get some cool perks and rewards. But the people who get the most value out of credit cards, especially ones with rewards, are the ones who pay them off regularly and avoid carrying that debt. So the bottom line, use your credit card for purchases you can already afford, treat it like cash, and pay the balance whenever possible.
Great. So now we've talked a little bit about what credit is and how credit cards work, and we'll talk more about how you actually build credit and what impacts your score. So your credit score is essentially a snapshot of how you've handled borrowed money over time, and lenders use it to help decide whether to lend to you and what interest rate to offer you. And as Melissa said, a stronger score can make it easier and less expensive to borrow money for things like a car or a home, an apartment. So the most important factor in your credit score is your payment history, which essentially means, are you paying your bills off on time or not? Paying on time is really the best credit habit that you can build, and even one missed payment can have a negative impact. So I've set up auto pay on my credit cards so that I don't have to think about paying them off at the end of the month, because I know that eventually I'll forget one, and that one missed payment can have a negative impact that stays on your credit history. The next big factor in your credit score is credit utilization, and this means how much of your available credit you're using. So when I opened my first credit card, I thought it was good to use the full limit of the card. I had like an $1,000 limit and I spent the whole thing on the first month. I later learned that that behavior actually looks risky to lenders, so it's a no-no. Another factor in your credit score is the length of your credit history. So the longer you have accounts open, and as long as you're managing them responsibly, the more positive history you create, which is often one reason why you might hear people say, don't close your credit card, even if you're not using it, especially if you've had it open for a long time. And then finally, the number of accounts and the types of accounts also contribute. So, for example, if you have a diverse mix of a couple of credit cards and a mortgage and an auto loan, as long as you're managing them all responsibly, that contributes positively to your credit score. But this part is not as important as some of the other factors like paying on time. And you do want to be mindful of opening too many accounts too soon, because that can also look risky to lenders. Great. So I wanted to give a little more, dive a little bit more into credit utilization, because as I said, this is one of the areas that got me with my first credit card. My parents had always told me to pay everything off on time. I think my mom's actually in this webinar, so thanks, Mom. That was great advice. But they didn't tell me that I should actually also be mindful of how much of my credit limit I'm using every month. So when you apply for a credit card, lenders will determine your credit limit for your card based on a few different factors, like your credit score, your income, other debts, or lines of credit that you may have. So many first-time credit cards have a low limit, but your limit does not indicate how much you should actually spend on the card if you want to build your credit. And a good rule of thumb is to keep your spending to less than 30% of your available limit. So using the example on this slide, if you have a $1,000 credit limit, a balance of $100 to $200, that's great. $300 should be okay. But if your balance is $800, that means you're spending 80% of your available credit, and that may hurt your score. One thing you can do if you're midway through the month and you're already at like 30% of your limit is you can just pay it off partway through the month. You don't have to wait until the end of the month. So I did this last month. I had a spendier month. I bought a new laptop. And I just paid it off halfway through the month so that I didn't get above that 30% utilization level. So it's something you can do as long as you have the cash available. But bottom line, we put this quote, your limit is not a target, but a ceiling. Okay, so what actually counts as a good credit score? There's a range. So below 670 generally means there's room for improvement. Not that you failed, just that lenders may see you as a higher risk borrower and you may face higher interest rates until you're able to nudge your score a little bit higher with some of the habits that we've talked about. A score between 670 and 740 is generally considered good. So that means that you've shown that you can manage credit responsibly. Above 740 is very good, and then above 800 is considered excellent. So at those higher levels, borrowers tend to have more options available and may qualify for better rates. And we just wanted to recognize that it can feel daunting to build your credit when you're just starting out or if you're in one of those lower ranges. But just remember, your credit score is really a measurement of past behavior. It can totally change over time and improve if you start implementing good habits that work for you and are repeatable. And oftentimes it just takes a few years of consistent good habits to be able to improve your score meaningfully. Okay, so now let's talk a little bit about credit card debt. So as Melissa said, credit cards give you the option to just pay the minimum amount each month instead of paying off your full balance. But this can be very dangerous because of credit card interest. So as Melissa said, if you pay the full balance by the due date, generally you're avoiding interest. But if you don't pay the full balance, that unpaid amount rolls over to the next month, which is called carrying a balance. And the credit card company charges interest, which is often super, super high. So when you're comparing credit cards or you're looking for a card, you'll see this term APR, which means annual percentage rate. And that's the amount that the company is charging on your balance. So sometimes you'll see something like 0% APR for the first 12 months, and it can kind of lull people into spending on that card and then carrying a balance. And then it'll, jump at a certain point up to 20% or more. And to put that into perspective, mortgage rates are currently around 6 to 7%, and that's considered high based on recent history. So, credit card interest can be 3, 4 times that amount. It's high. And one side note, as I was preparing for this presentation the other day, I was reading a little bit about this, and almost 50% of credit card holders in the US do carry a balance rather than pay off their credit cards in full. So it's really common, sort of speaks to that headline on our first slide about more Americans putting essential expenses onto their credit cards, dealing with inflation and higher prices. But credit cards give you flexibility, but it's also very expensive. Okay. So here's another example. We really just wanted to drill in how expensive it can be to carry a balance. So in this example, you're spending $5,000 on a credit card and you have a few different ways to pay it off. And for the interest rate, we used this week's national average rate according to Forbes, which is 24.92%. That's not an extreme. That's the average. So the first option is to pay in full. You pay You spend $5,000 on the credit card, you pay it off at the end of the month, you're just spending $5,000. Or you can pay it off over time with a fixed payment amount that's maybe higher than the minimum, but not paying off the full balance. So that'll add some time to the amount of time that it takes to pay off the balance, and then you'll be paying interest over time. So you'll end up owing more than that initial $5,000. Or you can just make the minimum payment and pay down the balance that way. And that is the most expensive way to pay off your card because most of your monthly payment is going towards paying off of the interest. And so it takes a really long time for the principal to decrease. So in this example, almost 20 years later and almost $15,000 later, you finally paid off that initial $5,000. So you can see how just paying the minimum, sort of, as Melissa said, just begins to snowball. It's like a snowball effect, whereas just spending what you can pay off at the end of the month is the least expensive strategy.
So let's talk about how to choose your first credit card. If you're new to credit, our biggest recommendation is to keep it really simple. You don't need 5 different credit cards or some sort of complicated strategy. So start with one card and focus on learning how to use that responsibly. So when you're looking for your first card, find one with a very little or no annual fee. There are lots of beginner-friendly options with other useful features like cash back that might not have an annual fee. And once you get that card, use it for small, predictable purchases, things that you already pay for. So maybe that's gas, coffee, Subway, or just like a Spotify streaming subscription, whatever it is, because the goal is to build a positive payment history, not to increase your spending and buy more things and take big vacations if you can't afford it. And another important habit is to read the fine print before opening any credit card or taking out a loan. I know and I completely agree that disclosures are not exciting, they're really boring, but they do contain important information you'll want to know. And that includes interest rates, fees, and the payment terms. So, just so you know, the Truth in Lending Act requires lenders to clearly disclose all of these details to you in an easy to understand way. And if you look at it, it will help you to understand the true cost of borrowing money. And we believe the more informed you are, the better financial decisions you'll make. Again, I know I've said this a lot, but the goal isn't to spend more money. The goal is to build a positive credit history through using credit responsibly. And if you do that consistently over time, you'll be building a stronger financial foundation that will benefit you years to come. Maybe down the road when you finance that car or take out a mortgage, you could save a lot of money in interest. So now that we've covered how to get started, let's look at some different types of credit cards available and how to choose one that fits your lifestyle and your spending habits. Next slide. So there are so many different types of credit cards available, but the most common fall into 3 different categories that we're going to talk about, and let's dive in. So the first and most simple are cashback cards. So what these cards do is they reward you with a percentage of your purchases back in cash. And depending on the card, you may earn the same rate on all purchases, or you can get higher rewards in categories like groceries, gas, or dining. So for a personal example of myself, I shop at Amazon and Whole Foods a lot, and when they combined, it was great for me because I got the Amazon Prime Visa card, and what that card does is it hires cash back on purchases that I make through those companies, and what I do is I like to redeem them for rewards like on future purchases when I'm on Amazon. And cashback cards can be a great option if you pay your balance in full each month. Just remember that any rewards you earn can be quickly outweighed by the interest charges you're carrying if you're carrying a balance from month to month. So, I mean, as Tierney mentioned, interest rates are really high. So, if you only get a 2% cash back, but you're paying 24% in interest by carrying a balance, it doesn't make sense to have that card. So the second category of cards are travel cards. So what these cards do is they help you earn points or miles on everyday purchases that can be redeemed for things like flights, hotel stays, or they also have other travel related benefits. And an example is that in my personal life, I travel to California and Hawaii a lot because I like to spend a lot of time with my friends and family. So I have the Alaska Airlines Visa card. And what that does is I earn Alaska Airlines miles that I could use towards future flights. And I also get a really cool perk that includes the benefit of having a free checked bag. So, travel cards can be a great option for people who, in their personal lives or maybe work lives, they travel regularly and they can take advantage of those perks. But with this card as well, it's also important to compare annual fees, the type of rewards program, and how you can redeem those rewards to make sure that it does fit with your lifestyle. And the third category is something called balance transfer cards. And these cards are typically designed for people who are trying to pay down credit card debt. Many offer a 0% introductory APR for a set period of time, which is usually around 12 to 21 months. And what this does is it allows the borrower to focus on paying down debt without accumulating additional interest. So they're basically paying off that principal balance that they transferred to the new card. So an example of this is someone who has a $5,000 balance on a credit card that has a 20% interest may opt to transfer that balance to a card offering 0% APR. During that promotional period, more of their payments will go towards reducing that principal balance that they transferred over rather than paying and continuing to accumulate interest. So, another thing is it's important to note that these cards also might have what they call a transfer fee. So, again, reviewing those disclosures is really important to do. So these cards are totally effective for managing and consolidating debt, but that's if you pay off the balance before that promotional period ends. And these cards are generally for people who already have established credit and outstanding debt rather than those who are just beginning to build credit. So let's talk about how to find the right card for you. So how do you choose a card and use that card? Well, there are a lot of options out there, but again, this is another process that doesn't have to be too complicated. Again, the best card for you depends on your spending habits, your financial goals, and how well you can manage a credit card responsibly. So we outlined a few steps. So the first one is to look at your real spending habits. Pull up your bank statement or recent credit card statement and look at the last few months. See where your money is actually going. So, is it grocery stores? Is it gas? Is it dining out? Pay attention to where you spend the most money will help guide you to the type of card that you choose. So step two, what you want to do is match the card's rewards to your lifestyle. So for example, as I already pointed out, a simple cashback card, super easy. Many offer around 2% back on everything you buy. No need to track categories or activate bonus categories. You just earn rewards on all your spending. Another option is category rewards cards. So these can pay higher rewards, sometimes 3 or 4%, even more. for certain categories. So for example, if you eat out a lot, a dining rewards card might make sense because that's where you'll earn the most cash back. They also have just gas cards. So say if you drive a lot or commute to work or you drive for work, that might be a good option for your lifestyle. So then there's something called rotating category cards. And what these cards offer is higher reward rates. So sometimes like around 5% or more. But these cards actually require work on your end because you'll usually need to activate the categories each quarter. So you'll get an email saying, hey, these are the categories. Well, you'll earn more this month. So maybe it's like a utility bill. You actually have to go in there and activate that. But these are also great, but it's only if you enjoy tracking rewards and we get that we're all really busy people and not everybody wants that extra work. Step 3, we highly recommend doing this is to calculate the annual fee math. So not all cards with an annual fee are bad. So we're not suggesting by any means that you just avoid them, but just to make sure that the benefits justify the cost. So for example, if you have a credit card that has a $95 annual fee and you get 2% cash back, what that calculates to for your spending needs need to be about $4,750 per year just for you to break even on that card. And after that, after you hit that spending, the rewards will start to outweigh the fees. And step 4 is using sign-up bonuses wisely. So sign-up bonuses can definitely be worth real money, but that's only if they fit into your normal spending habits. And I think I've probably said that like 10 times now. So for example, there are beginner cash cards that offer a really nice bonus of maybe like $200. And that's if you spend $500 within like the first 3 months. A lot of people can reach that goal easily with their normal budget. So I like to look at that as essentially free money just for doing my normal monthly spending. But then so a travel card might offer 75,000 points, which roughly converts to about $750 for travel rewards. But that could be after meeting a larger spending requirement. And that could be a great option for someone who travels regularly. And then what we have is what we like to call premium cards. And those cards tend to advertise huge bonuses. But the catch is they often require very high spending. So I recently saw one that they required $12,000 in spending, and that's just like within a few months. And it came with a really substantial annual fee of almost $900. And a card like this, especially for a beginner, is where people can get in trouble. So if you're trying to spend extra money just to earn that bonus, it's probably not a good idea. And it definitely gets people into trouble. So I'd say the key lesson is that sign-up bonuses are only valuable if you are going to spend that money anyway. Don't buy things just to earn the bonus points, because honestly, like 1 month of carrying a high interest rate can wipe out much of that bonus. And another strategy Tierney and I would like to touch upon is what a lot of people do is they pair 2 different types of credit cards together. So for example, you might have one simple everyday cashback card, and those are for, again, purchases you would normally make, gas, groceries, coffee, sandwiches, and then have another credit card that's a category or travel card for your bigger spending areas. And again, that's what I do in my personal life. I use the Amazon Prime Visa for my Amazon and Whole Foods purchases, and I get cash back on top of that I just use towards my Amazon Amazon purchases. And I also use the Alaska Airlines Visa for travel because flights are one of my larger annual expenses, and I take advantage of all those perks and the airline miles that I earn. And there's also a really good website I like to recommend. So if you are looking for a card and you want to be able to compare them, we really like to go to the Points Guy. And I find this card or this website really helpful because what they do is they basically do all the research. They compare the annual fees, the reward rates, and they have the sign up bonuses laid out. And they also have a section or a column I really like when comparing cards is who is each card best suited for. So I highly recommend that, the Points Guy. But I'd say just remember there's no single best credit card. There's only the credit card that is best for you and the way that you spend your money and with your habits and your lifestyle. So now I want to talk about more ways to build credit. Um, so I know we talked a lot about credit cards, but they aren't the only way to build and establish credit. There are actually a few other options that can be really helpful too. So one option is to become an authorized user. So this is when a parent or a family member adds you to their credit card account. So an example of this is when Tierney and I were preparing for this presentation, we realized that we were both authorized user on our mom's cards when we started college. So what happened is our moms just added us as an authorized user on one of their cards. And what that did was it gave us access to the account, like in terms of spending. So we got our own card, but it also helped us to start building our credit. And that's because the account's payment history is also reported to the credit bureaus. And an interesting fact we discovered is that about 1/3 of Americans are authorized users on at least one account. But I'd say the important thing to remember with this card is you're being added to someone else's account, right? So be cautious of whose account you're being added to because it can help you for one, but it can also hurt you. And that is because if the primary card holder isn't managing their account responsibly, like missing payments or carrying large balances, that can also negatively impact your credit. And then another option is called a secured credit card. So let's say you applied for a credit card, a traditional credit card, and you don't qualify it for yet. A secured card can be just a great way to get started. And what you do is you have to put down a refundable deposit, and it's usually a couple $100, maybe $300 or $500. And what that does is that becomes your credit limit, and you use that card just like any other card. And finally, one thing that we wanted to clear up, which tends to confuse a lot of people, and it confused me a lot when I was just getting started building my credit as well, is hard inquiries versus soft inquiries on your credit. So basically, what a soft inquiry is like when you check your own credit score, and Tierney will explain this more later and like why you would want to check your own credit score. So again, when you check your own credit score or get pre-qualified for a loan or credit card, um, that's just considered like a soft inquiry, and it really doesn't, it actually never affects your credit score, no matter how often you check. So that's really good news if you do a soft inquiry. But a hard inquiry is when you actually submit a credit card application. So what that does is it can cause a small, like temporary dip in your credit score. But the good news is a lot of people don't know. Like, let's say if you're shopping around for a mortgage or an auto loan and there's multiple inquiries within a short period of time, those inquiries are treated as a single inquiry for credit scoring purposes. So do not be afraid to compare rates and find the best deal for you. Again, the bottom line with with me explaining all of this is that there are multiple ways to start building your credit. And let's talk about building some smart credit habits and managing your credit cards wisely. So, building credit, building good credit is actually not that complicated. It mostly comes down to developing a few good habits and avoiding some common mistakes. So, the best thing that you could do is to pay your balance in full each month. I know I've said this a few times already, and I just want to stress that that's super important because it helps you avoid those expensive interest charges. And it also shows lenders that you're able to manage credit responsibly. And I'd say, like, again, I know we all have busy lives, but maybe setting up auto pay can be a great safety net. That way you don't miss one payment. And then even if it's like a day later than the due date, interest will start accruing. So I highly recommend setting up auto pay. That's what I do. I think that's what Tierney does too. um, and the next tip is it's important to continue to track your spending and to stay within your budget. And credit cards, that credit limit is not free money. Think of it again as a loan, as a tool, and how you use it really matters because it can work against you, but it can also work for you. So now I just like want to talk about a few habits that can work against you. So carrying a high balance can hurt your credit score, and making the minimum payment again can cause interest charges and also debt to grow over time. It's that snowball effect. Missing payments can lead to late fees, which are pretty expensive. And I, I don't know if the credit card companies will actually ever waive them, maybe one time, but you want to try to avoid that at all costs because it can have a negative impact on your credit history. And just also remember, like we get all these ads for these cool sign up bonuses that sound so great, but like it can be tempting, right? But applying for several cards, like in a short period of time, can make your finances harder to manage, but it also will raise red flags with lenders and can potentially lower your credit score. Um, so I know this is a lot, but there is good news in that is that like all of these things, and hopefully this presentation helps you realize all of these things are within your control by paying on time, keeping your balances manageable, and using credit thoughtfully. You really will be setting yourself up for long-term success.
Great. So we also wanted to touch on credit as part of your overall cash management plan. And for those of you who didn't watch our Financial Foundations webinar on budgeting, it's the last one, I would highly recommend watching it because strong credit really does start with strong cash habits, which is basically knowing what comes in, what goes out every month, and then having a good system to track your spending. Credit problems usually start when somebody uses a card to cover expenses that they didn't plan for or they can't afford right away. So, one of the best ways to protect your credit is to build that awareness around your cash flow. And then also, Melissa kind of touched on this, but develop your own way to resist that constant messaging and marketing that we're all receiving all the time. It's honestly not easy, but it makes a big difference. So, one protection against credit card debt is building an emergency fund. And this is honestly one of the most common pieces of advice that I experience us giving to clients, which is make sure you have money set aside for unexpected expenses. Money as in cash, not money in the market. Your starter goal might just be, setting $500 or $1,000 aside in a high yield savings account, and that can help you not put an unexpected medical bill or a car breaks down or you drop your phone in the toilet, you need to buy a new one, something like that on your credit card. And then ultimately, we do recommend building 3 to 6 months of living expenses in your emergency fund. And this creates a stronger cushion for something like a move or job loss or another reason for a period of reduced income or higher expenses for a period of time. So the takeaway is if you have savings, you can use credit as a tool and not just as a backup plan. Okay, we also wanted to touch a little bit on buy now, pay later products because they've grown a lot in the last few years. And I'm sure we're all seeing them when we check out online, if you're online shopping. So for those of you who aren't aware how they work, they essentially let you pay for purchases in multiple installments without owing interest if you're making your payments on time. And if you don't make your payments on time, they also have really, really high interest rates. So the important thing to remember about buy now, pay later is that there's still a form of credit. So the same principles apply and they can impact your credit score. So we put some of the main providers on the slide, Affirm, Klarna, Afterpay, Sezzle, and the reporting landscape differs from provider to provider. So I just want to caveat that this information might change. Um, but as of 2026, Affirm basically reports everything to the credit bureaus. So missed payments, on-time payments, it can contribute to positive credit history or not, depending on your behaviors. Klarna reports some information. Afterpay generally doesn't report unless something's unpaid and goes to collections, and then Sezzle has an opt-in feature. So it's just important if you're using these services, know how they might impact your credit score. And then be aware of stacking plans. So just be aware if you're using buy now, pay later for multiple purchases at once. It could contribute to overspending if you're not budgeting for making those installment payments. Okay, so this slide is really important, especially as fraud and scams become increasingly common and increasingly sophisticated, especially with AI now, it can be really hard to tell when something is a scam. So protecting your credit also means checking your credit information and watch for anything that doesn't look right. So one important habit is checking your credit reports. And your credit report is different than your credit score. The report shows all the details behind the score. So your accounts, your balances, your payment history, and then credit inquiries. And you want to review your reports at least annually and look for mistakes. So that's anything listed incorrectly, anything reported wrong, or anything that you don't recognize that could be a sign of identity theft, like if somebody's opened an account or a card in your name. You can check your credit report in a few different ways. There's a government authorized website called annualcreditreport.com, or you can make accounts at the three credit bureaus, which are on the slide, Experian, Equifax, and TransUnion. And then you can pull reports from each of those three credit bureaus and compare them to each other. And they will look different because lenders sometimes report to different bureaus and also they use slightly different scoring methodologies. So you'll have a little bit of a different credit score at each bureau. They should be kind of in the ballpark of each other, though. You shouldn't have a low credit score at one and a really high credit score at the other. That would probably be a red flag to look more into. So yeah, look for something if anything looks off. And then you can also sign up for credit monitoring services. This is helpful because it lets you track changes to your score and it sends you an alert if something new appears in your file. So I personally have a Capital One credit card. So I use CreditWise, which is Capital One's like credit monitoring service. And so sometimes it'll send me an email like your score has changed. And I can look more into it if I want to. And then a third tool is a credit freeze, which we also often recommend to clients if they're not planning to apply for a new loan anytime soon. So a credit freeze, it doesn't prevent you from using your existing lines of credit, so you can still spend on your credit cards, but it prevents anyone from opening a new account in your name. And then you can lift it if you need to apply for a loan, like if you're refinancing your mortgage or applying for a car loan or something like that. Okay, So, what to do if something does look wrong on your credit report? So, again, you want to look at all three of your reports since they can be different. And if you spot something like an account that's not yours, or an incorrect balance, or a late payment you don't recognize, you'll want to gather documentation and then file the dispute with both the credit bureau and the company that originally reported that information to the bureau. And then the bureau has 30 days to investigate and it has to remove anything that it can't verify. And this process is free, so you don't need to hire like a credit repair company necessarily. And then on the identity theft side, if you see an issue that doesn't look as much like an error, but more like fraud, so like different accounts being opened in your name that you don't recognize, you'll want to go to identitytheft.gov and they will build you a recovery plan. And then you'll definitely want to freeze your credit at all three bureaus, add a fraud alert to your file, dispute fraudulent accounts with the bureau, and then if there has been actual financial loss, you can file a police report. So the takeaway is just being vigilant about monitoring your credit report so you don't end up suffering because of a mistake or of a bad actor that brings down your credit score. Okay, so this is our last slide. We'll revisit a couple of key actions, then we'll move on to Q&A. If you're joining us today and you're just getting started, just remember there's a lot of complexity in the world of credit, but you don't need a whole bunch of cards or a complicated reward strategy to start building a good credit score. You can start simple, open a card that's manageable. When I was out of college, I just opened a no annual fee cashback credit card that I honestly still use today. It just works for me and I like the simplicity, though my limit has grown over time. And then use your card for small purchases or just things that you would have spent on anyway, and be mindful of how your credit card spending fits into your overall budget. Step three, pay it off monthly. This is the most important habit that we want to leave you all with, which is going to pay major dividends for all of us over time if you are paying off your cards monthly, paying off your loans monthly, and building that positive credit history over time without accumulating debt. And then the last step is tracking your progress, checking your statements, reviewing your spending, monitoring your credit score, and paying attention to what's changing over time. So we put this cheesy quote on the top of the slide to sum up. Small habits today create big financial advantages later, but it's really true with credit. So thank you, everyone. Hopefully that was informative, and we can move on to some Q&A.
That was fantastic. Thank you so much, Melissa and Tierney, for all that great information. We can hop right into Q&A. I know we're running short on time here, so I'm going to try to prioritize a couple of these and hit the high level ones. The first question is, at what age should someone get their first credit card? Probably not a perfectly clear answer there, but maybe a range would be helpful.
Yeah, so we recommend young adults get their first credit card around 18 to 22 years old, and actually legally to get their own credit card. They do have to be 18, but they can be added as an authorized user on a parent's card. The other thing is there is a range, but it's also about best time for your life. So we say 18 to 22 years old, but if you don't have like a good source of income to pay off that card, or to pay off that balance in full each month, that can create some issues. But also just understanding how, if you're at that age where or time in your life where you understand like how they work and have a basic budget, then great, open a card.
Yeah, I think one thing I would add to that is that having a credit card isn't right for everyone. So I think, you have to know yourself and know that you're going to be able to manage it responsibly and pay it off every month and not use it as a tool for overspending. And so it may vary based on the person.
Okay, great. We'll hop to the next one. Is having no credit better than having bad credit? What happens if you have no credit history, and can you still qualify for a loan with a low interest rate?
So that's a really good question. Typically having um, no credit is better than having bad credit, but again, you don't have a history to qualify for better interest rates. So typically, companies will reserve those for borrowers who have a known history that are less risky because they really have no way to judge you without having a credit history.
Awesome, that makes sense. Another one coming from Shy Robinson. What will the changes with the new FICO 10 rating system look like?
I'm not
That's a good
familiar with that.
question. Yeah, so the FICO 10 rating, so there's a bunch of different scoring methodologies out there. So there was FICO 8 and now FICO 10 is being rolled out. I honestly don't know a whole lot about it, but I do know it's, I think, supposed to be more holistic in terms of looking at your whole financial picture. And then also, um, late payments are ding you even harder.
Yep,
And I'm not sure if FICO 10 is being used across the board or if it's just um, kind of getting rolled out.
got it. Okay. Yeah, I know for a fact that there is a much greater negative impact for missed or late payments with the new system. So you hit that on the head. That's great. If and when an authorized user is removed from a credit card, how does this affect either party's credit, if at all?
Yeah, that's a good question. So typically it won't affect the primary card holder, but depending on the authorized user, just on what like their credit history looks like, and if they have other accounts open that are helping um, build their credits a good credit score, the impact may be smaller. But yes, for the authorized user, it will have like a slight dip. But again, if they're already established, it will have very little impact.
Got it. Okay, that's helpful. I think we have time for one more. Melissa, I know you were talking about those soft inquiries, those soft pulls earlier, and you said if you were looking for and comparing rates between different car loans, for example, that those could all be kind of viewed as one inquiry. Do you know if there's a specific time limit for to get all of those in to make it look like one inquiry?
Yeah, so it does depend on like the agency, but it's typically around like 14 to 45 days. So a couple weeks to just a little over a month.
Got it. Okay. I know we have a couple more questions in the chat. If we didn't get to your question, we can follow up with you and get all those questions answered. But really wanted to wrap up the series. Again, Tierney and Melissa, thank you so much. You all did a fantastic job today. I myself learned a bunch, and I'm sure the audience did as well. We are so excited to be bringing this initiative back next year for our third year of Financial Foundation Summer Series. We're hoping to juice up the content and continue getting you all interested in learning about these really important topics that we truly feel are underserved and understudied in today's world and environment and education system. So we think it's really valuable that you all are taking time out of your days to join us and invest in your financial lives as well. So thank you so much, everyone. Tierney, Melissa, thanks again so much, and we'll see you all soon.